Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. It's that time of week again where my business partner, Sam Rust, takes over the show and interviews our guests. I hope you enjoy the show.
This is your daily real estate syndication show. I'm your host, Sam Rust. Today with me is Clay Malcolm. Clay's been in the self-directed IRA and 401k industry since 2011, both as an educator and a personal investor. He combines his 20 years of education experience and expertise to educate clients, CPAs, CFPs, real estate professionals on the benefits of self-directed IRAs. Clay also holds a designation of a certified IRA services professional and has served on the American Bankers Association IRA steering committee. Clay, thanks for joining us this afternoon.
Hey, Sam, glad to be here.
Excellent. Well, I thought we'd start off, Clay, by just talking about the two items that you mentioned in your bio, a self-directed IRA, a solo 401k, kind of define the difference between those two, and then move from there to how we can utilize those in real estate, both from maybe a syndicator's perspective and also from a layperson, an investor's perspective. But let's start with some definitions, if you don't mind.
Sure, glad to. I always kind of look at it as 401ks are a little bit more sophisticated tool, a tax tool. I look at them both as tax tools, right? So these are both ways that you can engage your money and have some tax savings in terms of how your earnings on investments are treated. So, and the core concept for either of them, as far as I'm concerned, is combining the tax advantages with the account type with the returns that you can make on a real estate investment. So lots of people are familiar with IRAs and 401ks that invest in stock and mutual funds and things like that. But obviously, through self-directed IRAs and solo 401ks, you can invest in alternatives like real estate. So the real get is, again, combining that tax advantage with the investment earnings or returns that you can get from real estate. Now, I would say this, that 401ks have a lot more features to them. If the plan allows for it, it can have a Roth provision for the employee contributions. It can have a loan provision where the participant can take out a loan from the assets and things like that. So there, and there's some differences in terms of the way UBIT is levied and things like that. So the 401k tool is a pretty sophisticated one, and typically what we deal with is a solo 401k. So that's a person who's self-employed, and it could be them and their spouse if they both work for the company, but it's still a solo 401k plan. But that offers a lot of ability to mitigate or just change your tax status in a given year and for the long run. I look at IRAs as kind of a standardized version of a 401k. So a 401k, you have to have an employer that adopts a plan document, whereas an IRA is already kind of more formulated than that. There's a custodian that's required for any IRA product. And certainly there are a couple, traditional and Roth being the obvious ones because those two products are different tax status. But the operation of them all flows through the custodian. You don't have features like both traditional and Roth in the IRA's world. Those are two completely different account types. You don't have the loan provision, things like that. So, and I would say from a user perspective, it's just simpler, right? It's a much easier tool. It's something that we're probably more familiar with rather than a solo 401k that, you maybe name yourself the trustee and things like that, which incurs a lot of additional responsibilities and tasks. So I would say that the IRAs are kind of a standardized, easier to use in some ways version of 401ks. But again, both of those tools offer great tax benefits. And, as I mentioned at the very beginning, this combination of using the tax benefits with real estate can be so powerful. And one of the cool things I think about it is that you get to use the expertise that you have or that your real estate team has or that the people have right? So you get to, I often think about it like this. If you know how to make money outside of your IRA, if you have a system for that, you can often make money inside your IRA using that same expertise and the same investment strategies. You just have to take a little time to set it up properly at the beginning. But both of those accounts can be investors in real estate by, say, buying physical property. Could buy a single family rental or bigger property. And then also, and I think that this is becoming really, really popular for a lot of different reasons, a very attractive investment option is real estate syndications. So if your IRA doesn't want to be the sole owner or have a lot of the same responsibilities, a lot of times an IRA is investing in an entity that is collecting investors. And then that entity will go out and invest in something usually larger, maybe an apartment building, storage facility, office building, things like that. But all of those assets or investments that are considered to be quote unquote real estate, all of those are available for your IRA or solo 401k to invest in. So that's, I guess that's the message, is that your IRA can be a real estate investor. Don't let anybody tell you different. It can be an active real estate investor.
Yeah, so I've had numerous investors that have had people tell them otherwise, and you ask some questions, and I don't want to throw anybody specifically under the bus, but it tends to be the bigger custodians, right? What we've generally just directed them to firms like yours, like Advanta, and make them aware that, hey, there are other options out there, and just because it's against the rules of your custodian doesn't mean it's illegal. It's just they don't want to take the time to mess with it.
It's a really surprising thing because of the answer that people get sometimes. But I do think that it's just a historical artifact. I think in the 70s when IRAs were created, banks and brokerage houses seized on the rules and they built a business model around it. And essentially their offering is, hey, we'll be the custodian for your IRA. But while your IRA is with us, it can only buy the things that we sell. And of course, typically speaking, they're getting a commission from the sale of those publicly traded securities. So no harm, no foul. It is a business model built around the rules. But I think it's really surprising for most people that the rules, even way back in the 70s, included the ability for your IRA to invest in real estate and all these alternatives. It really just took the time of custodians who wanted to specialize in the bookkeeping and administration for those alternative assets to, become more a bigger part of the marketplace, right? So that you can have, multiple options and custodians where you can go and say, hey, these are the assets I want to get into. Do you service these things? So I do think that misinformation, or at least the fact that it's kind of buried, is really a historical artifact. But self-directed IRAs and alternative asset investing in general has proliferated so much in the last few years that I'm really glad to see this more mainstream.
Now, I want to go back to something that you had mentioned a couple of minutes ago, Clay. You kind of mentioned in passing UBIT, which, if I remember right, is unrelated business income. And I think I'm missing something there. But if you could explain for our audience what UBIT is, and then you had mentioned that there's a difference between how a solo 401k treats it versus a self-directed IRA. If you could speak to that a little bit, that'd be awesome.
Sure. Well, UBIT is unrelated business income tax, and it is a cost of doing business for a few select scenarios that your IRA might invest in. So I'll say it like this. So when your IRA invests and gets the benefit of debt leverage, so that means that your IRA is actually generating and receiving earnings or income that essentially that loan money bought. So if my IRA puts down 40% and borrows 60% to buy, let's say, a single family rental, essentially 60% of that property is owned by the debt. So I used other people's money to increase my buying power and to get a hold of that asset. But all of the assets return, the earnings come back into my IRA. Well, so the IRS looks at that and says, well, wait a minute. 60% of that money was not actually contributed to the IRA. You borrowed it from somebody else. And so that 60% doesn't really deserve the overall tax advantage that the 40% does, because you followed the contribution rules to get that money into the account. So what that boils down to is the fact that that 60% is earning something called unrelated debt financed income, meaning that's the income that is attributed to the debt percentage, right? The debt owns 60% in this case. So 60% of that revenue has the possibility of having UBIT associated with it. And so that means that and it is the net profit, it's not the gross, right? So if your IRA has an investment and it's benefiting from debt leverage, it is only the profit that's associated with the debt percentage, and it is a net profit. So you do get to use all the tools that you might otherwise use to reduce, the tax burden. But at the end of the day, for an IRA that has enough earnings that it would qualify to of unrelated debt financed income, that means that it would actually have to do its own tax filing. And the tax filing is a form 990T, 990-T. And it's essentially, you can think of it kind of as a 1040 for your IRA. And make no mistake, it is your IRA that is paying UBIT. It is not you personally. So all of this stuff that I'm talking about is occurring within the purview of the account, investing in something and creating returns. But part of that particular investment strategy, because it's taking advantage of the debt, is perhaps having to kick off a little bit or chip off a little bit of those earnings and send them back to Uncle Sam. But it is the IRA that is sending that money back as a cost of doing business using the debt financing. So it's kind of an interesting scenario in a couple of different ways. One, UDFI, generally speaking, does not apply to solo 401ks. So if you are self-employed and you're able to have a solo 401k and your strategy in terms of investment is to be in real estate assets and take advantage of debt leverage, the solo 401k tool may be a very advantageous choice for you to make because of the different treatment of the UDFI. You wouldn't have to chip off that money to back to the government for the cost of doing business. The other circumstance that sometimes can incur UBIT, and this one gets even worse because the acronym is so close, is when an IRA owns an ongoing business that is not housed in a C corporation. So basically what's happening there is your IRA owns a company, the company is making revenues, but if it's not housed in a C corporation, it could be in an LLC or it could be some sort of other arrangement, it could be a partnership. Then that ongoing business is not actually paying those corporate taxes. And the IRS again says, wait a minute. When your IRA buys stock in Apple, your returns are after Apple has paid its business taxes. So if there's no C corporation there, those business taxes aren't being paid. So we need to take care of that. And the way that they do that is through UBIT, and the unrelated income that it's called is unrelated business taxable income. So UBTI can mean that you have to pay UBIT, which is the unrelated business income tax. So either taking advantage of debt leverage or owning an ongoing kind of revenue generating business that's not housed in a C corporation, those are the two general scenarios where an IRA would have to pay UBIT. And of course, the solo 401k is really only looking at UBIT from UBTI, not the UDFI. So it's a tough topic to summarize. So I hope I didn't lose anything there.
No, I appreciate the thorough explanation, Clay. I think often I've found myself trying to explain it and not doing as succinctly as you do. It definitely doesn't help that everything has U's and I's in it. I've stumbled over that a couple of times myself. You mentioned that solo 401k is not subject to UBIT, at least in the real estate sense, right? In using debt related income. I can hear a lot of folks saying, well, what does it take to set up a solo 401k versus a self-directed IRA? What is the definition? Do you have to be working full-time just in your business, or how does the IRS classify that to be able to open that solo 401k?
Yeah, and it's an interesting topic because I think you can get a few opinions about who can and who can't. generally speaking, the concept is this, is that if you are self-employed, which means that you have an ongoing revenue generating enterprise, then you can open a solo 401k. Now, it can be a sole proprietorship. It could be an LLC. It could be an S Corp. Any of those types of structures are fine from an IRS perspective. And what happens is, just like in a larger company, except for the fact that we're just talking about one person typically, is the employer has to adopt a plan document. And the plan document is essentially the rule book for how this plan is going to operate. It has to comply with the Internal Revenue Code, Section 401k, coincidentally enough. And so the plan document, typically you'll either get one from an attorney, or you can, providers like Advanta have prototype documents that you can adopt. And basically, most often people will name themselves the trustee. And so at that point, the contribution streams are very similar to the way that you would have conceptualized that with a larger 401k. So you do still have to follow the rules, right? The rules don't go away just because it's just you. But the fact of the matter is the annual contribution limits are much higher than a traditional IRA or a Roth IRA. And I'll say this while we're talking about it, some self-employed folks also go for, or will choose an account type called a SEP IRA, Simplified Employee Pension, which also has much higher annual contribution limits. But essentially, once you've adopted the plan and named a trustee, it operates just like any other 401k in terms of the contributions. The distribution rules are the same. The plan document, though, I will state this because you can find a lot of solo 401k plan documents out there that don't allow for real estate investment. So when you are thinking about this type of thing, adopting a 401k plan, make sure that the plan document, the rule book, allows for that plan, the money that you contribute to it, to purchase real estate as an asset, because not all of them do. So, having a few of those nuances is important at the beginning, but after that, it operates very much like a 401k that you might be familiar with if you had another job. But the entity itself, that's not really defined, but it does need to be a revenue generating ongoing business. And if your business closes down, the IRS does think that you're going to close down the 401k plan as well and roll it over into something else. They believe in us that way. The other thing that really means the revenue generating aspect of it is important as well, because the contribution limits, obviously there is a hard cap on an annual contribution limit according to the plan, but they're also based on the revenue that is generated by that business, right? So you may not be able to contribute up to the annual contribution limit because the business didn't earn enough income to support that much contribution. So it is important, if you're going to adopt a solo 401k plan and your idea is to keep contributing to it over time, the business itself does need to be making some revenue, because your contributions are going to be based in some part on the revenue. So another thing to just keep in mind.
That makes sense. So let's say that you have an ongoing revenue generating business. You want to open a solo 401k, but you also have maybe some orphan 401ks from past employers. Can you roll those forward into your own solo 401k, or do those have to stay in as a self-directed IRA?
You can roll them in. Okay. It's pretty remarkable how flexible the IRS allows for accounts to be moved to one another, in and out of one another. So if you're no longer employed at a company or several, in some cases people have moved to a couple of different jobs, and you have those quote unquote orphan 401ks, they can be moved without tax and without penalty into the solo 401k. And that way they can all be operated from a single place. And it really does make the whole operation much more convenient for the account holder. That's for sure.
Yeah. Well, and I think the key is to get connected with an expert like yourself, Clay, and like Advanta, because it does seem like a Byzantine system, but maybe it's one of the few areas that the IRS has tried to make it at least straightforward to roll things out and make it simple. It doesn't have to be complex for its own sake anyways.
Well, I agree with you. And I would say this too, even if, I think it's very helpful to talk to somebody who's knowledgeable about the account types. But one of the things that really surprises me sometimes when I'm working with folks is the first thing I say is, let's take an inventory of the tax advantaged accounts that you already have and see what you're doing with them. And are they performing the way that you want them to, and things like that. And it's remarkable how many people have an old 401k that they forgot about, or a 457, or 403b or something. And in some cases, they don't actually understand that it's mobile. I think a lot of us, myself included, grew up thinking that these 401ks and these retirement plans were so intimately connected with the business and the IRS that it's just stuck there, right? And in some cases, people also felt, and I think I fell into this a while, this category maybe 25 years ago as well, that the investments are stuck as well, that I couldn't possibly wrest control of what's happening in those accounts. And so one of the things I think that's really liberating and freeing and just feels great about a solo 401k or a self-directed IRA is that feeling of, hey, I'm calling the shots now. Now that doesn't mean that you have to do it unilaterally. You get to use your real estate team and your lawyers and your CPAs, and you have your financial team together. But the idea that I was not limited, or that those accounts weren't stuck, was really liberating to me. And I find that a lot in people. I'm like, no, it really can be moved. You're okay. Well, let's figure out what you want to invest in and how you want to make that combination work, and find the tool that works for you, and et cetera, and go from there.
Certainly. Yeah, I've found that to be the case with the members of my own family, even just not realizing that you can self-direct those funds. It becomes a lot easier once you're out of whatever corporation initially set up the plan. And if it's a solo 401k plan, you get to create the rules. Shifting a little bit, this is a fairly specific question, Clay, but as an operator, we have a number of folks that invest through their IRAs with us in the multifamily syndication model, like you've alluded to. But every year, sometime in February or March, we start getting inundated with requests for fair market valuations. And there's a lot of different ways that people do this. Maybe the best practice I've seen, or I've heard of one group that went out and got appraisals every year. That seems excessive. I hear of a lot of groups that just give the beginning value that the account bought in at as the ongoing value until they sell. And then there's a lot of other avenues in between those two extremes. What is best practices from an operator standpoint to help your investors get their FMVs completed? And what do you recommend from that perspective?
Well, I do think that there's some variability in the way that the syndicators and other people who are kind of collection points for investors. I think there are some differences in the way that the paperwork and the agreement between the syndicator and the investor is set up. How are we what are the terms that we're going to use for dividends or returns on the investment? And, does that mean that we're paying back your principal, or does it not? And so there is some variability. So I don't know that I have a blanket rule for it, but I can give you the thematic kind of idea of what's going on. So one of the things that I think people don't always understand is that the IRS is tracking this money, right? An IRA and a solo 401k are accounts that are actual legal and financial entities that are different from you personally, right? Even though it's your money and you're going to benefit from it, the entity itself is different, and it's a different legal entity. And part of the reason why they require a custodian for IRAs and a trustee for 401ks is because that's part of their tracking system. And part of the tracking system, the upkeep of that, is this fair market valuation concept, so that every IRA has to have a fair market valuation each year. And the IRS is tracking that. Every IRA has to file a form 5498 that's done by the custodian, and it basically says how much the account is worth. A few years ago, they also instituted a change in the form 5498 whereby there are categories of investments. Prior to that time, it was literally Clay's IRA is worth $50,000. That's all they ever knew. But this fair market valuation concept is really part of the IRS's tracking mechanism. And the reason that they're tracking it is because they're giving that money special tax benefits, right? And it's different tax treatment than they're giving me or you personally. And so that's why they're tracking it. And in terms of the fair market valuation, I think that the best practice is really to just kind of take the terms of the investment from the investment documents and just follow that through and have a consistent path of, this is how we documented the value last year. This is how we're documenting the value the same way this year, et cetera, et cetera. The IRS is not, in a lot of cases, all that worried about the change in value, especially if there's no tax event that year. All right. A lot of times it's just the fact that this is how much the earnings are, and the IRS is just kind of keeping track of the fact that it's either making money or hopefully not losing money. But certainly some investments are superior to others. But the idea is really just this tracking mechanism. And so I would say that the idea of a complete appraisal or really intense valuation on a year, especially if there's no tax event, does seem kind of overwrought. I think that most custodians have a slightly different procedure for valuations in a year where there's not a tax event versus one where there is one. So, and I rarely see people take an in-kind distribution from a real estate syndication. You can, no question about it, but it's a little bit antithetical to the idea of why you use the IRA to invest in it in the first place. And so I would say that the valuations more often than not are going to be essentially viewed as non-taxable event kind of valuation. So I think consistency and the same set of supporting documentation each year is the thing that's really going to make the custodian comfortable that they're tracking the investment in the way that they are required to do.
That makes sense. So for the majority of sponsors out there, they're offering some sort of preferred return that isn't a return of capital, it's a return on capital. Say you invested $50,000 at an 8% preferred return, it's $4,000 in dividends, but that's being paid against the capital account. That doesn't go to the capital account. So it is conceivable that your fair market value at the end of year one could remain $50,000 because you're not counting that $4,000. Am I walking through that example correctly?
Yes. Okay. Yes. And so it's, and I also think that, venturing into the things that are probably a little bit off the syndication topic, there are certainly investments that are book value for 10 years. And then all of a sudden they're something different because that was the period under which that money was being utilized and really didn't have any mechanism or way to, keep track of the value because it was more speculative. When it comes to syndications, I do think that there's a much more well-trodden kind of track record for, is this a dividend? Is this return of capital? Things like that. But I don't think that any investor should really be worried if the valuation comes out where the number is still the same and they have some cash. That's all going to still get rolled into, I shouldn't use rollover anywhere in the IRA world, but it's all going to get be part of the 5498 filing. The cash will be added in, even if the cash is already back at your IRA. So the account itself will have the appropriate accounting. So it shouldn't necessarily bother anybody if the valuation that comes back from the entity is a little bit different or if it stays the same.
Okay. That makes sense. That's something that we've worked through. I know other operators are always trying to figure out best practices around that. So appreciate you shedding some light there. We could be on the regulatory topic for a long time, and I don't think either of us are gifted with prophecy. But I'm curious if there's anything in the short term that you see from a regulatory perspective at a higher level for either of the different retirement vehicles that we've talked about here today that we should be paying attention to or made aware of?
Well, I'm a huge proponent of making sure that everybody is aware that the Roth conversion rules remain very liberal. Lots of folks are not old enough to really realize that you didn't actually used to have the ability to convert any of the money that you wanted to from a traditional to a Roth. That legislation has changed, it was obviously several years ago now, but it remains the same. And what that means is that if any money that you have in the traditional IRA format, so pre-tax money, essentially in and creating earnings, can be converted to Roth. And part of the reason why I typically highlight that is because I think that can be well used as a yearly event, thinking about, okay, well, did I take a loss on another investment this year? Meaning that if I did a traditional to Roth conversion, which is a taxable event, would the loss that I took offset the conversion amount, the taxes that I would pay on the conversion amount? Or, for instance, I know that, income taxes has been a topic of conversation quite a bit, and typically is when there's a presidential election one way or another. And so do you think that the tax bracket that you're in right now is going to be a low one, historically speaking? And so does that mean that it's time to convert some money from traditional to Roth? And of course, at this point, again, because you have the ability to convert as much or as little money as you want, you can moderate and do conversions each year if you wanted to, trying to keep yourself under, you certainly don't want to, jump yourself up a tax bracket or something like that. But there's lots of ways for you and your financial team to look at the Roth conversion rules and see if it's appropriate for you. And you can do traditional to Roth conversions inside of a solo 401k plan as well. So understand that you have that ability too. But so from a regulatory standpoint, I think it's really interesting that having been on the ABA steering committee, because I did, we would have meetings and listen to the lobbyists and what things are under consideration and so on and so forth. And the change that you saw, recently, where the threshold age for required minimum distributions moved from 70 and a half up to 72, right? And so the compensating kind of regulatory or legislative effect or rule that was put into effect was we are also going to take away the beneficiary ability for the beneficiaries to take required minimum distributions for over their lifetime. So they cap the amount of time that the beneficiaries can be involved with the IRA that was passed down to them to 10 years. And so it was interesting to watch the balance, because a lot of these rules are really about the IRS and how much money they need and how they're going to get it from us. I mean, I don't want to make it sound too predatory, but if you think about why are the Roth conversion rules so liberal? Well, it's because they want people to convert, because that generates tax money for the IRS.
Yep. And dollars today are worth more than dollars in the future.
Right. And so all of these things have this kind of underlayment of how much money the IRS needs and what the circumstances are. So it's interesting to watch those legislative changes in the light of the need for the IRS to generate funds for the government. So I always tend to like that from a systemic standpoint. I've certainly heard lots of rumblings about, caps on the amount of money you can have in a Roth and this and that and the other thing. I haven't heard anything that's terribly substantive about that. But shoot, in a political climate that can change, the legislation can change. So I think that's another way where you just want to have a resource for the rules. Typically, that's your CPA or your enrolled agent or whoever it is that's doing your taxes. But certainly keeping abreast of those things, because again, you're always trying to take whatever tools you have, use them effectively so you can pay the fewest amount of taxes.
Yep. Totally agree. Well, one of our last questions here, Clay, and this is not real estate related, but to satisfy personal curiosity, can you invest in cryptocurrency inside of a solo 401k? Is that something you guys have experience with or have seen done?
Yes, absolutely. So both IRAs and solo 401ks can invest in cryptocurrency. The environment for that is really kind of unusual, and the exchanges often have a lot to do with your ability to do that. So some exchanges will have direct relationships with IRA custodians. Some will not. So in some cases, your IRA would have to have something called a checkbook control LLC as a strategy in there. So a technique for moving the IRA money down to an LLC level, which that entity at the LLC level could then go to the exchange and open up an account. Solo 401ks, in some cases, again, can invest directly with some exchanges, but in some cases they need an LLC or an entity in the middle. It just depends on what the exchange is willing, the type of entity that the exchange is willing to open an account for. And it can be very frustrating, but do understand that exchanges, first of all, they haven't been dealing with cryptocurrency for very long, and the regulatory environment that they're going through, it changes all the time. And so I'm sure that they're trying to keep up as well as they can. They're trying to keep up with security and any number of other things. So there are some limitations in the services that are available. But we are starting to see exchanges catch up a little bit to the idea of working directly with IRAs. And what that means for an IRA holder is that your cost of acquiring cryptocurrency via your IRA is coming down. And the red tape that's in the middle is also starting to dissipate some. But often there's still, if you want complete freedom, often you're looking at that LLC scenario, et cetera, et cetera. And if we talk about, changing environments, that's a huge one. So, but bottom line is, yes, IRAs and solo 401ks can invest in cryptocurrency.
Excellent. Well, I'm glad to hear that. Clay, really appreciate you giving us some time today. If folks want to learn more and explore what options would be out there for their retirement vehicles, how can folks get a hold of you? Where would you direct them?
Yeah, you're absolutely welcome to contact me directly. My direct office line is 470-695-0620. And my email is cmalcolm, cmalcolm, @advantaira.com. And I'm happy to talk to you, even if you're just kind of exploring the idea, talk about basic concepts, or if you have a really specific investment scenario and how an IRA could be combined with it. That's also a great conversation to have. So please do feel free to reach out. Happy to do it.
Excellent. Thank you for joining us on another episode of the Real Estate Syndication Show. Have a great day.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.